Okay, right now we're going to look at one of the most basic concepts in accounting, which is the accounting equation. Assets equal liabilities plus owner's equity. A stands for assets, L equals liabilities, OE stands for owner's equity. Under owner's equity, there are several components. Common stock is the first one, and it represents the owner's investment in the company. Revenues aren't technically part of owner's equity, but they affect owner's equity. So for analysis purposes, we're going to start with the assumption that revenues are part of owner's equity and they have an increasing effect on that component, owner's equity. Expenses have a decreasing effect on the value of a business. Liabilities are the obligations or the amounts that are owed to outsiders of the business. And assets stand for the resources that are owned by the business. These three components allow us to analyze transactions to be able to determine the value of the business and the results of operations. So for a minute, I want you to stop and think about some examples of assets. Cash is one example. Land is another. Buildings, supplies, and accounts receivable, which is typically called AR, which stands for work that's been done for a customer, but they haven't paid us yet. So we are owed money. It's an asset to the business because they are waiting to collect the cash for the work or the services or the goods that have been provided. Now I want you to stop and think about some examples of liabilities. Accounts payable is the most common example. It is abbreviated AP. And pretty much anything that ends with the word payable at the end, that's the signal that we're talking about a liability. So blank payable, salary payable, rent payable, taxes payable, insurance payable. Then under the owner's equity section, that OE section, now we're going to look at those components a little more carefully. So common stock, as I mentioned at the beginning, refers to the owner's investment of money into the business. We're going to be talking about large corporations like Google or Apple where there are millions of shareholders and they own common stock and it's evidenced by the money that they've put into the company. Or we can be talking about a family-owned business where just the family members own the shares of stock. Then we have retained earnings. We're going to see what this looks like when we start to create the financial statements. This is where the prior year's profits and losses go to rest. That's why they use the word retained. We've held on to our earnings. And then there's dividends, which represent the repayment of prior profits to the owners of the business. So it's not an expense. It's considered a reduction of the equity. It's a reduction of the retained earnings amount when we distribute profits back to the owners of the corporation. Under revenues, the types of accounts we'd be dealing with would be consulting revenue and fees earned. And the revenues always represent the amounts of value that we've provided in goods and services to our customers. And lastly, we have expenses, where pretty much anything blank expense, sort of like we did with payables, generates the expense accounts. So salary expense, rent expense, insurance expense, and all of these represent the amounts or the values where we've used a resource, and we're using the resource in order to generate revenues. So these are the basic components of the financial statements. Hope it helps. Have a good one.